All right, guys, thanks for joining me at the Standen Standard. And before I get into today's video topic, I want to ask you guys a favor. I want you to think of some arbitrary item or object that you purchased on a weekly basis or on a daily basis, a cup of coffee, something like that. And think back to if you lived 100 years ago and whether it cost the same amount. What about 200 years ago? What about 2,000 years ago? If you're like me and you came to the same conclusion, your answer was most likely no. And that brings us to gold. That's what I want to talk about today. And say 2,000 years ago, if you had an ounce of gold, you'd be able to purchase a brand new, beautiful toga. Now, fast forward to the 1920s. It's the boom. You want to go out on the town. You want to show off that beautiful pinstripe three-piece suit. An ounce of gold will get it for you. And fast forward to today, and you guessed it, an ounce of gold will still purchase a $3,700 suit today. And that is the power of gold. It maintains its purchasing power through economic crises, through wars, pandemics, inflation. And because of this history and the confluence of factors that I'm going to share with you today, I believe that gold is set to go much, much higher. So let's get into it. All right, so as we can see, a little foreshadowing in my title. So the first reason gold is going to go higher are these central banks, these huge geopolitical and unemotional players. They're not like retail investors. They are purchasing because they are trying to divest and diversify away from the dollar. As you can see here, they have historically held FX reserves in terms of U.S. treasuries, but now they're holding more gold than U.S. treasuries in reserves. And why is that? The main catalyst, in my view, was in 2022 when Russia invaded Ukraine. And then after the United States government, we sanctioned Russia and froze those assets. And what that told the world was that their assets, their reserve assets, could get frozen as well. So we're really starting to see it pick up. And like I just said, gold has surpassed the treasuries in terms of foreign reserve holdings. Inverse relationship. As this gold goes up, as our government spends more and more and more, increases the amount of debt, the debasement and the devaluation of the dollar. As you can see here, as the dollar loses its purchasing power, gold goes nowhere but up. And the central bank floor. So in my view, since central bank buying is so unemotional and so strong, and I would guess that they are dollar cost averaging each month, they're buying just a certain amount of gold for whatever that dollar denominated amount will purchase them. And as you can see, over 1,200 tons was purchased in the last year from these central banks. So in my view, this is going to be an extremely strong demand tailwind. And that brings us to the money supply. So there's a definition down below, but really I just want you to think of money supply as the amount of dollar units that are in savings, checkings, and CDs that are available to chase goods and services. And as you can see in the top right, it is ballooned to over $22 trillion. And if you think about fiat currency, if you think about the dollar, it can be printed. If we're now at $22 trillion and the amount of gold, the supply only increases by about 1.5 to 2% per year. That means in terms of for every ounce of gold above the ground, it's worth more. So that's how I think about that. As you can see here on the left, just what we talked about, gold prices versus the money supply, they're both going up and to the right. And on this right-hand side, this shows the percentage of M2 percentage growth per year has been positive. There's a little blip after COVID where it contracted sharply after trillions of dollars worth of stimulus post-COVID. But now it's back to about 5% growth per year in terms of the money supply. So shows no signs of stopping, which is going to boost gold's price in my view. And this ties in to deficits, into government spending, the big beautiful bill. When Trump came into office and he said, we're going to cut spending, Doge completely turned 180 on that. And now we have this big, beautiful bill where the Congressional Budget Office has projected out that it's going to be approximately $3.4 trillion just in tax cuts. And that's not even including the deficit spending that we discuss. Deficit spending right here, $2.1 trillion. And what this shows is that as a percentage of GDP, the United States is at the highest. It's at 7%. So if the GDP is $30 trillion, we spend 2% or a little over $2 trillion in deficit spending per year, which means we spend $2 trillion more than we bring in terms of tax receipts. In addition, we have tariffs. So Liberation Day, tariffs, uncertainty, volatility, not governments, excuse me, these companies, these large corporate entities, they don't know what to do in terms of going out, investing into the real economy, or maybe they're pulling back, okay? This shows here on the right-hand side, after Liberation Day, the gold versus S&P skyrocketed. And why is that? It's because when these tariffs hit, it was very, very challenging, and it still is, for these companies to forecast their profits and losses. So what are they going to do? They're going to pull back on investment. They're going to maybe not hire as many people. They're maybe going to try to reduce wages, or they're going to cut back on hours. And what else is going to go up? These investors and these companies are going to flood into gold. And you can see that on the right-hand side here. Can I get a job? This ties into the already anemic and fracturing job market. So we just talked about tariffs. We just talked about how these companies may not, or rather are uncomfortable investing in this type of environment. As you can see here on the left-hand side, most of the jobs have come from the government sector, right? 73,000 jobs, with the next one being 58,000. If you take those away, there's almost no job growth in the private sector. In addition, on the right-hand side here, it shows that there's a downward revision in non-farm payrolls. And basically what I want you guys to take away from this, if nothing else, is that the revision was down by over 1 million jobs. That is huge, guys. All right. The Federal Reserve, in addition to a weakening labor market, they are now switching into a rate cutting cycle. So this gentleman on the left-hand side, Jay Powell, he's the Federal Reserve chairman, looks a little nervous. He's fixing his tie. He has succumbed, in my view, to external pressure from the Trump administration to cut rates at the short end of the yield curve. And what this means, why this is important for us, guys, is as these rates decrease, the opportunity cost for owning treasuries versus gold decreases, because the amount that you're receiving on the income of the interest goes down because rates are getting cut. As these rates get cut, the gold price goes up because a lot of this capital moves over to gold. And you can see here, opportunity cost from 1980, we were in a bond bull market, okay? And what that means is yields went down, the price of bonds went up. And as the yields got to a point where really it was, especially with all this geopolitical uncertainty going on, there really was no viable alternative. And gold, especially as a volatility and uncertainty hedge, really skyrocketed in comparison to these decreasing yields. On the back of this is the dollar weakening, okay? So in the left-hand side here, you can see the dollar was around 110 a couple of months ago, and it has gone down to about 97, which is an unprecedented decrease and weakness in the dollar. All right. And why this is important is as the dollar weakens, this denotes that the supply of dollars, or the amount of dollar credit available globally, is increasing. And that increased amount chases hard assets like gold. And on the right-hand side, you could see here that, and I hold this view, is that because of this tech bubble, there's been trillions upon trillions of dollars worth of capital that has been stuffed into the US equities market in these AI companies. And you can see it reflected in the Mag 7 with astronomically high valuations. All right. And as this begins to unwind, I'm not saying it's going to unwind just yet, but in my view, as capital looks for a new home, it's going to go out of that tech bubble and into hard assets like gold. And it's not just a US dollar story. Gold is rising in almost all fiats that I can find in my research, and then also in emerging market currencies. And what this means to me is that gold on a global basis is being repriced. This is extremely important. And this cuts out the noise between the aberrant strengthening and weakening of the US dollar, in my view. And if you see it across the board, increasing in all of these different fiat currencies, it means that globally, like I said, they're starting to reprice gold. In terms of the supply, so we've talked about all these different geopolitical and monetary debasement tailwinds for gold. Now, in terms of the supply of gold, what this shows here is that as a percentage of the global equities, mining is at a meager 1%. So this shows that the amount of capital that these mining companies for gold have been absolutely starved for affection, for lack of a better term, and have had undergone conditions where there's been gross underinvestment for over a decade. And why this is important is we talked about the demand, not just from these central banks, including Poland, India, China, which is, like we said, most likely going to cause a floor in gold. We've also got this supply. And remember, I spoke earlier about the constant amount of supply added each year, 1.5 to 2% of gold. Well, with this chronic malinvestment and underinvestment in the gold sector, the infrastructure is not there. It takes about a decade plus to get a mine online. From discovery to actually putting a mine in place, it can take upwards of 20 years. So as you can see, the demand, in my view, is going to grossly outstrip supply and lead to higher prices. And lastly, I wanted to finish with a little bit of technical analysis. When I look at these charts, this is the chart of gold. I have the 50 and the 200-day moving average highlighted here. And why this is important, guys, is if these moving averages are trending up to the right, that trend is your friend. So there may be aberrations and pullbacks along the way, as you can see here on this chart. But in my view, this is a chance to buy the dips because the trend is only going up and you don't want to fight it. All right. And lastly, let's concentrate on capital flows. When I do my research, yes, I'm more of a macro top down kind of guy. I don't really go into the micros of all these companies, but I really do pay attention to capital flows. And as you can see here, they're really from 2022 up until about the end of last year, there were almost negative flows. So money was leaving these gold exchange traded funds. And, and then since February, you've really seen this astronomical increase, almost $12 billion that have flooded into these ETFs. And in my view, are going to continue increasing the demand and thus the price of gold. So to tie it all together, guys, central bank buying, they are dispassionate buyers. They are unemotional, and they are purchasing gold to get away from the dollar and decrease the chances that they may get sanctioned, and then also to be able to undergo trade with each other and settle in a neutral reserve asset such as gold. We talked about the increased spending, the big, beautiful bill, the ridiculous 7% fiscal deficits that we run outside of war and recession. We talked about an anemic job market. We talked about the revisions that have been almost 1 million jobs down. That in turn, as people lose their jobs, is going to put stress on corporate earnings. Think the Mag 7. As that stress culminates, it's going to cause capital outflows. The dollar is weakening. All right. The dollar, and I jumped ahead here. The Fed cutting cycle is in response to a weak economy. As the rates come down, the dollar will start to weaken. But like I said, I believe that we're already in a structural dollar weakening cycle as the AI bubble, as the everything bubble starts to pop. And like I said, gold, it's not just a US dollar story. It is rising in all fiat currencies and many emerging market economies. That means that gold is being repriced globally. The chronic underinvestment in supply, that means that the demand versus supply is going to be outstripped and the price is going to continue to increase. And remember, the technicals, if it's going up and to the right, don't fight it, buy the dips. And that concludes this video on gold. Thank you so much for tuning in. Stay informed, stay vigilant, and I'll see you on the next video. Cheers.